This year's been an interesting one for the bank sector. I think the newspapers have really been focusing on record profits, but that actually hides a slightly different story, particularly when you focus on the corporate sector. I think it's actually been quite a tough year, with mostly deals held up through refinancings and not a significant amount of financing activity due to the slowdown in M&A and not a significant amount of capital expenditure projects going ahead. So pricing has been coming down as banks have been competing against each other. Funding costs have come down too, but query whether it's to the same extent. So it's actually quite a tough market out there, I would say, in corporate banking. So I think regulatory change is really what is affecting the bank sector the most significantly at the moment, and it just seems to come in various waves, whether it's domestic, whether it's global. Domestically, just a couple of examples. APRA last year introduced essentially a policy that looks at banks that are too big for the system, and it asks them to allocate more capital than they might have otherwise have had to previously. That's got to be introduced by, I think they've got to be effective by January 2016. There's another piece of regulation that's coming in that's called a conglomerates policy that really looks at banks that have wealth management arms, insurance arms and other types of activity, and they actually look at the institution as a whole and ask them to put aside the right amount of capital to cover off all of those risks so they can't sort of double count. So that's just domestically, and then overlaid on that you have global regulators such as Basel III that are looking at how banks need to hold sufficient amounts of capital. You have foreign governments introducing regulation which has extraterritorial effect. So there might be anti-money laundering, anti-corruption, tax avoidance, so FATCA being an example there. You have legislation from the States, Dodd-Frank. You have regulation in Europe, which is EMIR, and the consequences of those I don't think are truly felt, particularly by the derivatives market locally yet. And I think if you put those and you overlay the extra capital adequacy questions that go along with trading in derivatives, that there might be some corporate treasurers who get a bit of sticker shock going forward when they're dealing with international banks and investment banks in particular, and seek keenly priced hedging solutions. They might be in for a bit of a surprise, I think, in the next year or two. On top of all of that, of course, is a financial system inquiry, and no one really quite knows yet what that's going to do. It's likely to change the way in which banks are regulated, and it's likely to change the way in which banks are taxed. Now that might end up just promoting innovation, which could be a good thing. So, you know, I suppose out of all of that wave of regulation, it's likely to drive innovation, and it's likely to drive banks pushing off-balance sheet solutions to their clients, and we're quite excited to help with that innovation.